You know, if you've been following the financial world lately, you've probably felt it. Things have just been incredibly volatile. Well, let's dive right into this fascinating explainer because today we're unpacking some deep underlying data from Ambrose Capital that reveals how the very architecture of modern U.S. equity markets has been completely rewired over the last decade.
Seriously, why does the market feel so utterly unpredictable right now? You get these wild, whiplash-inducing intraday swings where the market just plummets, only to rally aggressively a few hours later. It feels like pure chaos, right? But the source material suggests there is actually a very rigid, mechanical reason driving all of this.
All right, Section 1, the illusion of stability. To really get what's happening, we have to look past that surface-level calm that keeps rewarding dip buyers and giving everyone this false sense of security. The source material uses this brilliant metaphor of a forest fire artificially starved of natural burns. Because every single small market dip over the last several years has been bought up immediately, we've basically prevented the small, natural brush fires that keep a forest healthy. Instead, we've just allowed immense, dangerous amounts of dry kindling to pile up. So here's the crucial takeaway. Our modern market is increasingly governed by this concept called reflexivity. Borrowed from George Soros, reflexivity simply means that an investor's actions feed directly back into the market environment, which then changes the environment, prompting even more of that exact same action. It's a massive feedback loop. Small moves are reversed quickly, making things look super stable, but this exact same mechanism can turn a tiny spark into an absolute inferno when things actually go wrong.
Moving on to Section 2, the speculative frenzy spark. Let's look at the first layer of kindling, the spark itself. We are seeing a completely unprecedented speculative frenzy today. I mean, just think about Dogecoin for a second. It's a cryptocurrency started as a literal joke. But in May 2021, it reached a staggering peak valuation of $85 billion. At that time, that made a joke coin more valuable than established real-world giants like Ford, FedEx, and Uber. The psychology of the market has just fundamentally shifted.
This broader euphoria is absolutely everywhere. Take Warren Buffett's famous market cap to GDP indicator. It clearly shows we're in this hyper-aggressive, wildly risk-seeking environment. Valuations have hit historic, completely euphoric highs. We've got a whole generation of investors whose only experience since the 2008 financial crisis is a market that basically just goes up.
And you have to compound that with a new generation using mobile phones to aggressively trade highly volatile instruments. We're talking about a massive wealth transfer to millennials mixing with this intense YOLO and FOMO trading culture. With instant app trading, this new money isn't quietly going into traditional fixed income. No, it's pouring into speculative tech, crypto, and a tidal wave of call options. These participants are acting like unpredictable matches tossed into our dry forest.
Which brings us to Section 3, the options feedback loop. We are witnessing a massive, frankly mind-blowing explosion in options trading. It's acting like a violent wind fanning those speculative flames. It's grown so astronomically since 2017 that the notional dollar value of option positions is actually on track to eclipse common stock positions. Think about that. The derivative tail is now quite literally wagging the equity dog.
All this creates something called dealer gamma hedging. It's a mechanical feedback loop that forcefully drives market momentum. See, when millions of investors buy options, market makers, the dealers, are forced to take the other side of that trade. To protect themselves and stay neutral, these dealers have to buy or sell the actual underlying stock. And here is where the reflexivity really kicks in. The dealer's massive stock trading pushes the asset's price up or down, which then forces the dealer to buy or sell even more stock just to stay protected. It's entirely blind and divorced from a company's actual fundamentals.
Because of this price-insensitive hedging, we get this bizarre illusion of stability during quiet times. Dealers are just constantly adjusting and buying the dips. But during a shock, if a stock suddenly drops sharply, dealers are mechanically forced to aggressively sell off the underlying stock, which actively accelerates crashes. It's a massive, totally hidden feedback loop.
Let's look at Section 4, squeezing the market makers.
So who is actually processing all of these trades? Well, it's an incredibly concentrated group of institutions. Astonishingly, data from the Comptroller of the Currency shows that just 4 large commercial banks represent 89.3% of the total banking industry's notional derivatives amounts. Think about the immense concentration risk here.
Almost all institutional and retail order flows are bottlenecked through a tiny handful of players, like Goldman Sachs and JP Morgan. In fact, roughly 80% of retail contracts go to just 4 main wholesalers. The entire market's plumbing is relying on a very, very small group of entities.
But here is the real kicker. After the 2008 crash, Dodd-Frank regulations put hard limits on the risk banks can warehouse. While totally well-intentioned, it created a huge secondary consequence. During a crisis, regulatory limits force these few banks to quickly shed risk to stay compliant. They mechanically pull liquidity and dump assets, creating an incredibly destructive game of pass the hot potato right when the market desperately needs them to be stabilizing forces.
So, what actually happens when billions of dollars are put completely on autopilot? If options and regulations are already forcing this mechanical buying and selling, what about the actual investments themselves?
Let's dive into Section 5, the passive investing autopilot.
Take the 5 largest ETFs in the US right now. They hold hundreds of billions of dollars. But here's the catch. They all carry substantial, overlapping exposure to the exact same massive tech stocks. Apple, Microsoft, Amazon, Google, Tesla. True diversification across thousands of listed stocks is increasingly becoming an illusion.
By 2021, something historic happened. Passive investments officially outweighed active funds. We're talking $7.3 trillion in passive open-ended ETFs compared to $6.6 trillion in active ones. This means a massive chunk of market capital simply buys or sells blindly based on index weightings. It completely ignores underlying company valuations. If a stock is in the index, the fund buys it. If it's not, it doesn't.
This passive autopilot literally forces index funds to blindly buy soaring stocks. Take Tesla's crazy 20x run-up in just a few years. Once it gained momentum and was added to the S&P 500, institutional investors were forced to buy it, purely to stay indexed, regardless of its sky-high price. Add in leveraged daily ETFs that have to aggressively rebalance their portfolios at the end of every single trading day, and you are pouring even more systematic, unthinking fuel onto the fire.
Finally, Section 6, a market made of kindling.
When you step back and look at the whole picture, it's wild. We have this illusion of calm masking absolute underlying chaos. We've got speculative retail sparks flying everywhere. We have gale force winds from massive options hedging. We have a highly concentrated bottleneck of dealers strictly constrained by regulation. And we have trillions of blind, passive dollars all interacting in one massive, reflexive loop. When things are going up, this structure forces the market higher and higher, creating an incredible illusion of unstoppable stability.
But now that you've seen the reality beneath the surface and the absolute mountain of dry kindling piled up in the market structure, you really have to ask yourself, are you prepared for the fire when the next inevitable spark flies?